Okay, the last section of chapter 18 is 18.4, acquiring additional capital. We have two learning objectives. You need to be able to identify factors influencing financial decisions, and you need to be able to analyze the impact of financial leverage. So, cost of capital. This is the ratio of interest and dividend payments to the proceeds from debt and capital financing. That list of factors there, that's what we want to consider in how a business then should raise capital. So we want to look at things like the interest rate, what impact it will have on earnings, the repayment terms, the ownership control, and the debt ratio. The ability of a business to use borrowed funds to increase its earnings is called financial leverage. So what we're looking at here is a chart that looks at the financial leverage at different percentages. So we can see that we have operating income, the interest expense, net income, after and before federal income tax, what the investment is, and then what the return on that investment would be. This is showing us then our different financial methods. So we can see line of credit, notes payable, bonds payable, and then they have some other liabilities in there too. So we can see what it looks like then for our financing. All right, number one, identify 5 options available to a business to raise capital. Lines of credit, notes payable, bonds, common stock, and preferred stock. Number 2, identify 5 factors that a business should consider in deciding how to raise capital. A business should look at interest rates, the impact on earnings, repayment terms, ownership control, and debt ratio. Number 3, what is necessary for financial leverage to increase earnings? We need to make sure that the borrowed funds must be invested in the business to earn an income that's higher than the interest that's charged for those borrowed funds. Number 4, how might individuals describe a business having a high level of debt? Those businesses might be described as highly leveraged or over leveraged. And last question, number 5, what might force a corporation to issue additional stock? A debt ratio of the corporation that exceeds its debt ratio benchmark. Okay, that was the end of 18.4 lecture. Go ahead and go to the 18.4 work together video.